Can cover calls outperform the market? In this video, that's exactly what we're going to dive into with this document that was put out by Asset Consulting Group. I put out a poll to the community just asking what kind of video you would want to see. This is the one you all voted on, hands down. But in this video, we're going to see how a cover call strategy that's been back tested to 1986 to 2011, how it would have done. We'll go page by page, graph by graph, and see exactly how a cover call strategy would have done against the S&P 500. So let's jump in. Okay, as of January 2012, an analysis of an index option writing for liquid enhanced risk-adjusted returns. So we'll go through this executive summary. It just basically says that we compared a performance of 4 options-based benchmark indices, BXM, BXY, put, CLL, and performance of more traditional indices over more than 23 years. Highlights of the findings include the following. In this one, I really just want to focus on BXM. Why BXM? Because it is a options-based index. So you can't buy this. It's not an ETF. It was created by the CBOE, which stands for the Chicago Board Options Exchange. Basically, institutions and clients were interested in figuring out, well, what would a 100% cover call coverage over a portfolio over an S&P 500 index at the money, how would that do over a period of decades? BXY is similar in the sense that it's 2% out of the money, full coverage over the whole index. So again, you can't buy this. It's not an ETF. It's just an index like the S&P 500 or the Russell 2000s or the NASDAQ 100. One of the first things that popped out to me is just total growth. We see that BXM actually performed over the time period 830%, 9.1% annualized, whereas the S&P 500 did 807%, 9% annualized. As we scroll down the page, we see that all these tickers, basically what they all mean. You can see for BXM, right, it holds 500 companies at the money covered call option over the entire portfolio. Exhibit 1, I'm not going to cover that. Exhibit 2, growth of $1. So had you invested $1 in BXM back in 1986, it would have turned into $9.30 by June 2010. And we see that the S&P 500 pretty much followed the same pattern, especially towards, as we see, the Great Recession in this time period right here, 2008. And it returned, that $1 would have returned $9.07. Okay, page 2, comparing annualized return and standard deviation. So if you annualize out in that time period, we see that 3 of the 4 CBOE option strategies did better than the S&P 500 annualized. And then with Exhibit 4, we actually see that all 4 CBOE option strategies had less volatility than the S&P 500 annualized. And all this really means is what is 10%, or say for BXM, what is 10%? It means it can, the average swing, 10% this way, 10% that way. Whereas the S&P 500, it was 15% this way, 15% that way on average. Okay, Exhibit 5, return and volatility. All this simply means is on this chart here, we want to be higher up and we want to be further to the left, right? So higher up and closer to this corner. Like this would be pitch perfect right here. We see the S&P 500 in this little blue square. BXM is again further to the left, which we like, means less volatility, and it's slightly higher than the S&P 500, outperforming. Exhibit 6, various time periods. I'm not going to speak on this too much, but BXM annualized returns over these time periods outperformed the S&P 500. Same with the BXY, the out of the money, the 2% out of the money did as well. And then standard deviation, we see that the S&P 500 had more swings than both of these strategies in each time period. Okay, Exhibit 7. So you see a bunch of shaded areas. All this simply means is that these shaded areas outperformed the S&P 500 down here for each of these years. So BXM outperformed in 5 of the 11 years that we can see here. There were a few pretty close years like 2005, 2004. S&P blew away BXM in 2003, but BXM did actually pretty good in 2002, at least when it came to retaining your capital, right? S&P dropped 22%, whereas BXM only lost 7.6. So it just goes to show in the years that the S&P 500 was down, cover calls are meant to hedge against further dropping. So you should do a lot better in down years than the S&P 500. Okay, then on to page 3, we have histograms with frequency of monthly returns. So with Exhibit 8A, all we're looking at here is there are 282 months between 1986 and 2011. And all this shows is that there were 10 months that the S&P 500, and it was not back to back. It just says there were 10 months out of that time period where the S&P dropped 8% and below, and BXM there were only 5 months where there were only 5 months where it dropped 8% or lower. So we can see that BXM outperforms pretty much all the way up until this 2 to 4% range. So once we get into 4 to 6%, the S&P starts to outperform. There were 31 months where the S&P 500 outperformed the BXM in those individual months. And then Exhibit 8E, we see frequency of returns. Again, in the 282 months in that time period, BXM had 200 positive months where the S&P 500 had 178, meaning that 71% of the time BXM was up, whereas the S&P 500 in that time frame was only up 63%. And then we had the highest month. BXM had 10%. Lowest month recorded was 15.1. S&P, the highest month it had in that time period was 11.4, and then 16.8% it was down for in the lowest month. Then we have returns relative to the S&P 500 over under charts. So we'll just look at, for BXM, Exhibit 9A. So we have this trend line here in blue that represents the S&P 500, and each of these individual dots represent a quarter the returns for BXM. So if you're under this line here, it means you had negative returns in that quarter for both the S&P 500 and for BXM. And then anything above this horizontal line was a positive return. This is an interesting way of just visually seeing, like, okay, how many quarters did BXM say outperform? But there were plenty of months where it was up, and plenty of months where it was, or plenty of quarters where it was above the S&P 500. One of the things that I thought was really interesting was actually page 6, which was impact of adding option benchmarks to a traditional strategy, because I get the feeling that it's kind of like an all or nothing thing with cover calls, but that's like the furthest thing from the truth. There are way more cover calls out there that have like partial coverage on the ETF. For those who don't know, an ETF just tracks a bunch of stocks. There's a bunch of stocks held within the actual ETF itself, the exchange traded fund. So what this is going to show is that if you simply add 10% of the CBOE BXM strategy, which is the 100% cover call coverage at the money, and we'll see how it performs in these next few charts. So we see a traditional 60-40, 60% invested in the S&P 500, 40% into, say, bonds. But if we slash out 10% from the S&P and add it to basically BXM, the CBO option strategy. Let's see how it performs. So exhibit 15A, again, we want to be higher up and we want to be closer to this corner. Like this corner right here would be the best possible situation. So again, further over to the left and higher up. And see that the traditional strategy, 3 of the 4 CBOE option strategies outperform and are less volatile. And we get a breakdown of what that exactly looks like. BXM slightly outperforms on an annualized basis and is less volatile by whatever that is, 0.5%, call it, on average. And I just also want to point out, this is the addition of options benchmarks during the past 23 and a half years. So it covers the time period that this analysis has been done. But it gives 2 other examples of, in exhibit 15B here, addition of option benchmarks during bullish periods. So in this example, 1988 to 1999. If you're familiar again with cover call, cover calls naturally, the more coverage there is on it, it drags on price. So in a bullish period, typically a traditional portfolio or anything that doesn't have cover calls on it typically will outperform in a total return basis. So we see that an example here, that traditional portfolio does outperform. The options strategy indexes are still less volatile, and BXM does trail in the bullish period. We see that traditional is 14.65%, where BXM is 14.41% over that time period. So still like decent annualized returns every year. And then, of course, less volatility with that strategy. But if we move over to Exhibit 15C, this is the addition of options benchmark during the period of moderate returns. And again, this is only adding 10% option strategy to the standard portfolio, the standard 60-40 portfolio. And you can see here that the traditional portfolio is still more volatile and the option strategies just 10%, just adding 10% to the mix, and it outperforms. So what does that exactly look like? Well, BXM is basically a 1/4 point better annualized in this period. I want to say from 1999 to 2011, you wouldn't have made much. If you were investing in the S&P 500 during the 2000s, I want to say it's like maybe a cracked 1% over that 10-year period. So with BXM, you would have done a little bit better. Okay, so now that we're at the end of that, maybe we want to ask the question, okay, this analysis covered 1986 to 2011, but what about after? What did, say, BXM do from 2011 to 2023 to today, which is day of recording, May 1st, 2023. I got that answer for you, but we're going to have to break the charts out into different tabs to do so. So this is on the CBOE website, where you can actually look up different options indexes, and there's tons of them. So this is something, again, you can play around with. I'll link it in the description below. Okay, so now we're looking at BXM and how it would have done from the end of that analysis to basically the day of recording this video, which is May 1st, 2023. We can see that this actually increased over that time period about 100%. So we can see over the same time period that I just showed you with BXM, the S&P 500 actually rose 195%, which is incredible because it was an awesome bull run that we had in the past decade, but that necessarily won't be the case. The 2020s aren't necessarily going to be the 2010s. If anything, there's certainly a lot more pessimism in the air with the markets and inflation and interest rates and geopolitical politics and sovereign debt crises. There's stuff all over the world right now that just lends credence to pessimism. And I think one way of hedging against that is cover call ETFs. Now, one thing I do realize in this analysis is that it's not measuring a cover call ETF, but it gives us sort of the best indicator that we can potentially backtest to see just how cover calls would have done over the last few decades. So with that being said, I hope you all enjoyed that analysis and just the tidbits that were offered in there. It was a highly upvoted topic, and I've of course plan to do more of those in the future. So if you like this video, then please, as always, to help support this small channel just flourish, hit all the buttons of the like and subscribe variety. I appreciate all the comments. I try to get to as many of them as humanly possible, if not all of them. I really do try. And with that being said, I will see you all in the next video.